Welcome to Morphic Labs, and today we are going to be discussing relative entropy aggregation. But before we get into that, do me a favor, hit the subscribe button if you want to keep up with more content like this. And if you're interested in increasing your market intelligence, I have a free market microstructure and trading systems course that will walk you through the foundations of market structure, the mechanics of trading, market data, and analytics, plus a free advanced market aggregation course that will walk you through advanced price-based aggregation, volatility-driven aggregation, information theoretic aggregation, which is what we're going to be talking about today, order flow and microstructure aggregation, event-driven and hybrid methods aggregation, implementation and selection criteria. If you're interested, the links in the description. Just got to sign up to be a free member, and let's get into it. Now, what is relative entropy aggregation? Relative entropy, or Karl-Beck-Leibler divergence, probably butchers that, measures the difference between two probability distributions, useful for detecting when market behavior deviates from normal patterns. Relative entropy bars. These bars close when the cumulative KL divergence between current and reference distribution reaches a threshold. Formulas. Karl-Beck-Leibler divergence, or KL divergence, is defined as d sub KL of P and Q equals the sum of P of I times the log sub 2 of P of I over Q of I, where I indexes from I up until some arbitrary number, where P equals current price distribution and Q equals reference baseline distribution. Bar close condition is satisfied when d sub KL is greater than, or at least the sum of d sub KL is greater than or equal than sub d sub target. When do you use this aggregation? Regime change detection, anomaly detection systems, market stress monitoring, structural break identification, adaptive strategy triggering. The advantages: detects distributional changes. Another advantage is asymmetric measure of divergence, useful for regime detection, non-parametric approach possible, well-founded in statistics. The disadvantages of this type of aggregation: not symmetric. D sub KL of P and Q does not equal D sub KL of Q and P. Undefined when P of I is greater than 0 but Q of I equals 0. Requires distribution estimation. Reference distribution selection. Complex to interpret. Now, when it comes to requires reference distribution selection, I'm picking an empirical distribution instead of assuming a normal distribution or Laplace distribution or whatever distribution you would normally assume. I'd rather use a empirical distribution. Now I'm going to be using my 1 minute Tesla data, and I've already ran this for about 800 entries, and our D sub target is 3.5. And here it is. Now at the top we have our price, of course, and at the bottom we have our DL divergence. Now when you look at the geometry, pay attention to these red subsections over here. That's where our DL divergence essentially triggered our target, right? And as you can see, it didn't really trigger the target all that much, because after this spike in the DL divergence, it dropped and it stayed in between 0.0 and 2.5. But the moment that it did hit, pay attention. Over here, it hit once and it will hit again a couple times over here. And essentially, that represents a distributional regime shift, right? Or just a change of distribution, so to speak, where the distribution goes from, say, a distribution X to a distribution Y. Now, this is interesting, but let's look at it for different targets, right? Now, I'm going to try maybe a target of not that much above our 3.5, maybe a 4.2. And essentially, it hit it 3 times. Okay. Now, the vertical lines at the top obviously represent where our DL divergence met our target. And that represents a distribution shift. So essentially, if you were, I'm vaguely speaking, and this is not financial advice, but vaguely speaking, you could have easily saw this bar condition get met, and you could have guessed that, you know what, the distribution is about to shift, right? Where it's gonna shift, that's a completely different conversation. But you could make an educated guess that once this D sub target was hit by our DL divergence, or KL divergence, I mean, once it was hit by our KL divergence, there is a statistical guarantee that there's a distributional shift, right? So when you look at this, once our KL divergence was essentially meeting our target right here the first time, it dropped and then it came back again and then it just spiked up, right? And then it dropped again and then it stayed in between zero point 0.0 and 2.5, right? And when you look at the market right after these two bar conditions were met, essentially the market essentially started changing where it was going, right? Might have taken a little bit more time, but it did change its distribution. And that's why it's so important to pick targets with a strategy, right? If you watch my previous videos on market microstructure, at least the end of the market microstructure course, I talk about essentially picking your targets strategically, right? Instead of just picking randomly what the target is, you can use a certain set of strategies to make sure that the target you're picking isn't just being pulled out of your ass, right? Here it is parameter selection. Most aggregation methods require selecting a threshold or a target value. This should be based on the specific instrument's characteristics and analytic objectives. Common approaches include percentile-based set threshold at 90th percentile of historical distribution. Another way to set your target is event-based, target-specific number of bars per trading session. L volatility adjusted, scale thresholds based on recent volatility. So essentially, when picking your targets, I just picked the one I picked randomly because of content reasons. But if you're really going to be using aggregation to make actual trading decisions, you have to pick your target with a little bit more finesse and sophistication. But that's about it for today. Do me a favor, hit the subscribe button if you want to keep up with more content like this. And if you're interested in increasing your market intelligence, I have a free market microstructure and trading essentials course that will walk you through the foundations of market structure and the mechanics of trading, market data analytics. Plus, I have a free advanced market aggregation course that will walk you through advanced price-based aggregation, volatility-driven aggregation, information theoretic aggregation, order flow and microstructure aggregation, event-driven and hybrid methods, aggregation, implementation, and selection criteria. If you're interested, the links in the description. You just gotta sign up to be a free member. And before the week ends, I'ma be releasing my retail quant structural edge open research to the community members. And that's about it. I'm out.